Hey, Restorers, welcome back to, I believe, episode 10 of Chasing the Vision, season 2. We are talking about what's kind of always a hot topic, whether you're planning to sell or not, and it's valuations. People always want to know what their business is worth. And I know that it can also change pretty quickly depending on how well you do over a year or things like that. The economy and how things are going can change it. So there's a lot of factors that go into valuing a company. That's what our experts are here to talk about today, not me. I just get to ask the questions. So, JT, I'm going to kick this over to you to kind of lay the groundwork for what we're going to talk about in valuations, the kind of the direction we're going to go, and set the foundation for us.
Well, I feel honored. First, experts. The bar has been set high, so thank you for that. It is a big topic. Thank you, and it is changing. So you hit all the high points right there. Especially the last 24 months, it's changing rather quickly. First, by way of foundation, owners think that when you get a business valuation, it's about one number. And yes, it's about a number, but the real magic lies in all the little numbers that make up the big number and how to affect the little numbers and the story and ultimately how to affect evaluation. And I'm told over and over that the number was one thing, but now moving forward and the decisions that need to be made, that's where the real magic lies. And I'm sure we'll talk about some of that today. So as a foundation, that's where I'll leave it for now.
Perfect. All right, Tim, and any foundation you want to add? And I'm curious as well, because JT, I'm sure a lot of the people that you talk to every day are curious what their business is worth, but how often
Mhm.
does it come up for you in the consulting world of owners being curious, like what is my value, even if they're not thinking about selling?
Yeah, I think it's coming up more and more today than it has been in the past. And maybe it's just the popularity of businesses selling where, you're hearing more about it in recent years. But it does have people more interested in knowing if I had to exit the business or I wanted to sell my business, what's it worth today? And I mean, from a foundational standpoint, you should be asking yourself that question.
Mhm.
At the end of the day, I mean, it's why are we doing this? If you're just doing it for a paycheck, then that's one thing. But if you have a saleable asset, then that's even better, right? But to me, I mean, there's a lot of different reasons, whether it's selling or it's, looking to transition the business and sell it maybe to a management buyout, pass it down to the next generation. There's a lot of reasons why you should understand what your business is worth today.
Mhm.
But I do want to second JT's comments and uh, go back a bunch of years when I first met you, JT. I'm going to give you some selfless promotion now. When I saw the valuations that you did for clients that we were working with, or even maybe I think it was the first one I saw was on the buy side, where your client was actually looking to buy one of our clients. And I looked at it and went, wow, that's great work. I love the approach that you take when you come to it with, I think you called it the value drivers, or the
Mhm.
variables behind the story. It's not just about looking at the financials and saying, all right, this on paper is what it should be worth, but taking all these other things into consideration. That's really what drives those multiples that everybody talks about.
That was a perfect
Well,
lead
and
up. Go
yeah,
ahead.
thank you, Tim. Number one, but I want to jump in here. Like your clients, they need to be willing to learn and willing to pull back the sheets a little bit and understand more about their business. And it's the same with me. If you're not willing and really want to understand what's driving the value, then it's kind of a pointless exercise. So your clients and my clients start with being willing,
Mhm.
willing to know and willing to get better.
Yep.
When it comes to evaluation, JT, how much does the P&L report have to do with it, and how much do kind of these other story variables have to do with it?
Well, fair question. The P&L is foundational. You've heard us talk over the years about adjusted EBITDA, adjusted earnings, add back. So at the end of the day, you've got to be making some money, right? Or we're going to default to the balance sheet for evaluation, and nobody wants that. The assets at the end of the day aren't worth much relative to the overall value of a restoration company. So it starts with the adjusted EBITDA. That gets us a foundational value. And then the story variables, they can increase or decrease that number. And some of those story variables are really impactful. You can have a really strong company financially that the story variable might render it insaleable, like it's not even sellable. And that catches owners off guard, especially from 2020 to 2023, when everyone thought, you put a business on the market, it was just going to be moths to a flame and there'd be 100 buyers lined up. It doesn't work that way. And especially doesn't work that way right now in 2025. So the story is critical, and some of those story variables, which I'm sure we'll talk about. I mean, clean financials is going to come up. Buyers have to understand how you get to your adjusted EBITDA number, and you've got to be able to prove it. Dependency on owner is going to come up, I'm sure, a couple times in this conversation. The reliance on an owner and all the hats that he or she may wear. Client risk factors is another big one. If you've got 40% of your work showing up through a TPA or a single referral source or a single GC, let's say if you're a MIT company, there's a lot of variables that can push that figure up and down. And what I like to say when I'm talking to clients, you can have a $5 million company and easily have $1.5 million, $2 million swing on the value on a relatively small company. So understanding those variables is absolutely critical to making the best decisions moving forward.
Tim, anything you want to add there?
No, I mean, I would second everything that JD talked about, especially the owner independent side of things. And a lot of that comes back, at least in my experience, to the motivation of the buyer. Do they want the seller to remain with the business, or are they looking to actually, have them exit? But that probably occurs early in the process and in the discussions prior to an LOI even being issued. Because if there's a conflict there, and if the seller wants to stay in and the buyer does not want them in, then there's no sense even going forward with it. So, to the degree of that dependence, will determine the value. But there's one interesting one that keeps coming up, especially in recent years here. And we get asked by a lot of, especially the private equity side, to do some diligence work for them on very specific type situations. And the one that keeps coming up over and over again is the quality of receivables. And not just how good is the money that's hanging out there, because most of these deals are going to be debt-free, cash-free, and the receivables are going with the seller. But they want to know what is the quality of that stuff that's aging that's out there, because it tells a story operationally. One of the bigger concerns isn't necessarily margin in the business from a buyer's perspective, in my opinion, but how fast can we get paid? That's
Hmm.
the one thing that everybody struggles with. And if the business has set itself up operationally, it put itself in a position operationally where it's having a hard time getting paid historically, that's generally going to continue. And unless something is done completely different. So we've been seeing a lot of interest there. And like you indicated, JT, every number tells a story, and there's some good ones behind that number, is what we found out.
Yeah, Tim, really great point, because days outstanding last year and this year are climbing.
Yes.
And I think sellers are really trying to rapidly understand how to minimize that. So great point.
Yes. Tim, let's dig into that really quick before we move on, because that is such a big pain point in the industry. The state of the industry, which we were talking about
Mhm.
offline, just came out yesterday, and we did break it down this time between how it's going with TPAs, how it's going with independent, private pay work, those kind of things. But your clients that have figured out how to get paid quickly, maybe around that 30-day mark or less, what are they doing to make that happen?
Well, the biggest thing is they're setting the expectations up front.
Hmm.
And I still hold true to this, even though claims management or claims handling practices have changed, and everybody's dragging the dollar out a little bit. I'll concede that. It starts with good routine discipline, and the customer's not getting into it saying we're going to screw a contractor. The insurance companies are not getting into it saying we're going to withhold payment from a contractor. They're just going about it a little bit differently. But if your process to have the conversations clearly about who's paying this bill, how much are you going to be responsible for paying, when are we going to expect that payment before you start the work, if that conversation is not occurring, then chances are it's not going to occur next year or the year after that either. So, when you go to any small business service provider, call a plumber, call an electrician, have them come to your house, they're going to make it very clear. I expect to be paid when I leave here or when I show up, or you're going to get a service call fee or whatever. Like, they tell you that. Um, we should be employing the same best practices. So I'd like to think, Michelle, to answer your question directly, that our clients have been given the guidance necessary to do that. That's why our clients don't have as many problems as the traditional contractor that's out there. They follow a system, they stick to it, and they say no when they have to. and you have to do that sometimes.
Yes, that's absolutely right. JT, anything you want to add to that
Tim,
one?
I do. I have a question for Tim. I've seen more and more of my larger clients with sizable reconstruction divisions.
Mhm.
They're now negotiating upfront draw schedules.
Oh,
Have you
absolutely.
seen that with your clients?
We endorse it, JT. It's one
Yeah.
of the things, especially if we work with somebody that's got a construction or repair heavy service line.
Yeah.
We talk to them very early in our engagements about what your payment terms are, what's your contract language look like.
Right.
We talk to them about how you issue a notice of intent to stop work if they don't adhere to the
Yeah.
payment schedule, and then notices of stop work stoppage. And you'd be surprised. Look, I mean, if you're looking at $100,000, $200,000 loss, the insurance company shouldn't have a problem stroking a check for half of that
Hmm.
today.
Hmm.
We're not going to be that far apart on the scope. So whether you release the money today or you release it 30 days from now, shouldn't be a discussion, at least in my opinion.
Yeah.
And if it is a discussion, then maybe that's a job that you don't want to finance or you don't want to walk away from. You know?
Yeah. Terrific. Thank you for that.
Mhm.
There's probably a whole webinar on draw schedules and how to negotiate that, but I'm seeing more and more of it, and that's probably in part to Viola. So thank you.
It's a great best practice. Yes.
Yeah.
I was at a commercial summit with a lot of large restorers a few weeks ago, and this was one of the topics of conversation. And there was a pretty well-known restorer who was like, "We don't have problems with this, but you have to ask for the money. You can't just expect for it to come. You have to go out there and actually ask
Mhm.
for it." And that seems so simple, but I think that there are a lot of companies that also just don't ask for it. They're so afraid that they're going to lose the job or whatever that may be, and so they just don't ask. And if you don't ask, they're not going to just give you money. So.
It has to be, I've always
Hmm.
said, it has to be the most comfortable, uncomfortable conversation that you have with your customers.
Yep. Okay, well, that was a great tangent. So you're welcome to everybody who's listening because that's a good topic to always cover. Okay, so we were talking about some of the top variables that drive value. So Tim, I'll toss this to you first. Do you have like a short list in your head that it's like these are the top two or three variables that matter the most in the valuation process?
Yeah, and they're definitely going to come back to the intangibles that JT talked about. Hard assets in a restoration business, they have value, but they're not, on the grand scheme of things, not a large percentage of the total enterprise value of the business. So to me, it comes back to quality of the management team. You know, you've got to have good people in place, and assuming whether the buyer wants the seller to stay with the business or not, I think you have to enter the transaction with the assumption that they're not going to be there, at least over time. So having a quality management team in place to be able to execute on what made that business profitable to the beginning is probably the number one in my opinion. It's not going to show up as a tangible asset. You know, we like to say that people are sometimes even classified as a liability, but they're the ones that drive the business forward. And you have to get, if you can get buy-in from them early on, through some sort of pre-discovery discussions that occur. I know you got confidentiality issues and all that stuff, but if you can get to that management team prior to the transaction closing and get buy-in, that's about as good as you get from a safeguard. And then the other one, in my opinion, that we don't talk about a lot is strategy. And in today's day and age, we're always searching for, ways to add margin to the bottom line, looking for talking about ways that we can improve cash flow, all those good things. Beyond the fundamentals of business, I would look at, is there anything unique and proprietary that that business brings to the table? And I'm not necessarily talking about patented type stuff, but what processes or systems exist in the business that make them uniquely profitable in their own right, in their own market, and have them have the ability to produce a cash machine for the potential buyer that's there. To me, they're automatically more valuable. And it doesn't always have to be software platforms. It doesn't always have to be technology or equipment, but just the way you go about business. If it puts you into a different category, the buyers should be willing to pay for that.
Yeah. JT, what about you? What are kind of your top variables?
Well, the first one is back to adjusted EBITDA. You got to be making some money at some point. You know, as I like to say, we're not doing this for our health. We could be in a lot of different industries for our health. This is not one of them. And you know, Tim and I look pretty good for 21, by the way. We've been in this industry just a couple of years, and it's taken a toll. So once beyond the numbers, I think consistency, especially in 24, 25, consistency of the numbers right now is key. And you know, much of the industry is down because of the weather events, the claims, et cetera. We all understand what's happening. So then the question is, how do we keep it consistent? Or how are the numbers staying consistent? How did you get to similar numbers? Well, for some companies, it might be a couple of real big, large losses or a cat event. And for another, it might be 200 routine projects. Well, there's a difference there, you know, on the support and foundation of those numbers. So buyers right now are looking for consistency and repeatability. They don't want to go backwards and they want to bank on something moving forward. So consistency is key. And I know that's what Tim was talking about. We'll turn the quality of that management team and some of that strategy into, you know, hopefully that converts to a consistent future. So beyond that, I think he's spot on with the strength of the leadership team. At the end of the day, that's what a buyer's buying. And depending on the size of the company, you know, smaller companies, you get into sub 3-4 million, those owners are expected to turn over. There's going to be a qualified GM, PM, estimator, ops manager, et cetera, that's going to come in and take over. And the larger companies, you know, 6, 7, 8 million and up, those sellers are expected to stick around for a year or two or longer to help make a smooth transition. So the quality of that team on either end of that spectrum is really valuable.
Perfect. Okay, so those are all things that add value, but what if we flip the tables and talk about things that take away from the value or might detract from the value of a business? What would fall into that category? Tim, I'll toss that to you first.
Yeah, I mean, the first one that comes to mind was sloppy bookkeeping. You know, the value of the transaction is largely determined before the LOI is even issued. You might have some adjustments when you get into quality of earnings and due diligence and all that other stuff, but if you can't really determine what the business is worth from the books that you're giving somebody, then you probably have a problem on your hands. So, to me, that's the number one thing. I wouldn't call it a deal killer because usually once you get past the LOI stage, if you're in diligence and they're doing a quality of earnings evaluation of the business, they know that it's a mess when they get to that point already. But there are a couple deal killers that are out there, and I've seen a couple just recently where legal issue histories with legal issues, and I'm not talking about outstanding cases right now, but a history of them.
Okay.
And I don't know if if the diligence work that's out there is becoming more and more in depth, or maybe it's just the buyers and who they are or whatever. But they're digging deeper these days, and if they find something that they don't like, I've seen actually two deals this year go, the opposite direction. Now, I will say that we were to entertain an engagement with the buyer post transaction, not the seller that had the legal issues. So just put that one on the table. But either way, I come back to the numbers. The other one that is usually a surprise, I think, is the bookkeeping records from an adjustment or an add back standpoint.
Mm.
If you can't support the add backs, personal gain or benefit that's being expensed through the business, if you can't support that, then usually it gets discounted. So
Yeah. Okay,
something
JT, what
something to look
about
out
you?
for.
Oh,
I'm going to echo what Tim said. I mean, it starts with clean books. And I'll add to his thoughts by saying that inequality of earnings, which for those listening who have never heard of equality of earnings, that's where the buyer hires a forensic accountant and they go through the books to prove what we said it was. Okay. If we're representing 1.5 million in adjusted EBITDA, we have to prove that. And in equality of earnings, the rule of thumb out there is that if the earnings comes back and we're within 2%, there is no price adjustment. If we're greater than 2%, now the buyer is going to lift their eyebrows and say, hey, we misrepresented this. We found that. You forgot to include that. We're going to deduct for this issue. And so we've got to be within 2%. And that's why Tim and we take a great deal of time when we start talking about adjusted EBITDA. It's got to be accurate. And sometimes I have owners get frustrated with me because when they tell me something, I want to take it at face value, but also want to prove it because a buyer's going to prove it, and their attorney's going to prove it, and their forensic CPA is going to prove it. There's no place to hide. When you get into a quality of earnings, it's very invasive. And Tim, you mentioned lawsuits. They are looking harder. Attorneys will dig up things from 10, 15 years ago and say, tell me about that issue that you had. And owners are shocked that that discussion's even on the table. And sometimes, I ask extensively before we bring a company to market. I ask about legal issues, what's on the table, what was pending, what's been in the last 5 years, anything beyond that that's worthy of a discussion. And when it comes up, they're fully prepared to talk about it. When it catches them off guard, I sometimes hear, well, I didn't think they were going to dig that up. That was 3 years ago or 5 years ago. They're going to dig it up. Okay. That's the rule of thumb. It will be found and there's no place to hide. So the best way to approach it is openly and honestly and be ready for full disclosure. So that's what I can add.
JT, I'm just curious. So, we come at this a lot of times. We're talking about valuations now, and the
Mm-hmm.
valuation may be occurring with or without a transaction. How many times do you see a purchase price renegotiated as some of these things come to the surface during the diligence period?
It's a direct correlation to how honest the seller has been with me.
Okay.
And I hate to put it on the seller, but there are times when I will take 4, 5, 6 weeks trying to get to the bottom of an adjusted EBITDA that's accurate. And I'm working with a controller or a bookkeeper or the owner or any combination of, and they get a little frustrated with me because it's at the end of the day, we're debating the last $5,000 bill or the last, $1,500 bill, but it matters. And it matters because when the seller gets caught in a misrepresentation, and I won't say a lie, sometimes things are covered up on purpose, but in a misrepresentation, the smallest of numbers can break trust. And so I go to great lengths to make sure that's accurate. I've always gone to great lengths, but when I'm representing or consulting to a buyer and we're looking at a deal, it doesn't take long to look at those numbers and figure out what's a stretch, what should be pulled out, what they threw in there is sort of a gimme or a takeaway on our part. So it has to do with the diligence and the time spent putting it together. And if that's done completely, very rarely is there an adjustment.
Perfect. Okay, so all right, so we can't have this conversation obviously with talking about current state of the industry and how the economy, the claims volume, all the things that are happening in our industry today. So how is that affecting valuations today? So Tim, I'll toss it to you first again.
Yeah, I mean, there's two things that we're keeping an eye on right now, Michelle. The first one you and I have actually talked about before, which is this concerning trend with rising deductibles
Yep.
with the policies out there, and then the changes in the claim settlement practice. Not that we're seeing more denials. We're maybe just seeing things being been done differently. But when you talk about claims volume being down, there has to be a claim for there to count it. And when you have that rising deductible trend that's going on in an effort for people to maybe have a more affordable premium, whatever the
Yep.
reasons are, there are less and less opportunities to file a claim. Doesn't mean there's less and less damage occurring. So it's something that I think we need to pay attention to as the deductible amount reaches the average, say, water mitigation size, whatever, you've got a variance there and a decision for homeowners to make. So somebody still has to dry the house out, whether there's a claim there or not, and
Yep.
there may be an opportunity. So that's one item that we're looking at. But the buyers that are out there, whether it be the industry strategics, JT, or even the equity firms that are out there that are looking at this as an investment vehicle, because that's what it is for them, they have to take those things into consideration whenever they value a business. The other wild card for me really is the PE portfolio sales history, which is really going to get interesting in the next few years here.
Huh.
And a lot of folks that sold their businesses from 2020 on were either promised a certain return on their money. They took rollover equity. They chose to reinvest. They chose to stay with the businesses, or they had earnouts. And we're not seeing, or at least we haven't yet, the returns that they were the expectation that meet the expectation that was created there. So in other words, I don't think these portfolio sales or resales, these equity events as they call them, are as lucrative as were initially anticipated. So to me, that only has to devalue these businesses if that is the ultimate intention on the PE side. So something to think about and something to watch.
Yes, it is. JT, what's your take on this? And I'm curious, kind of as you're adding your thoughts in, how multiples maybe have changed in the last few years.
Well, there's a lot to unpack here.
Yeah.
I'll first just start with Tim's thought. It's some of these PE sales have not turned out, and some have been complete disasters, we'll say.
Mhm.
I'm in the middle of some negotiations now where we're trying to unwind a couple of deals, and there's going to be some interesting announcements made in the next few months. PE in general has suffered with integration, and they have made some promises they can't fulfill. And there's some good ones out there, but in general, the 50 to 75 PE firms looking to come in, and maybe they've got one or two or three locations. They don't speak restoration as well as owners speak restoration. And I'll just leave it at that for right now. So beyond that, you asked about multiples. Multiples are interesting. That in my seat, that's all I do is value and sell restoration companies. Multiples themselves have not suffered, and most people think they have, and they haven't. What has changed is the deal structure. And in fact, then I just had an article come out in CNR yesterday about this
Mhm.
topic, and it's a question that nobody's asking. They just call and ask about multiples. Multiples have remained the same with consistent numbers. Those aren't going to suffer. The structure has changed, and we're seeing more earnouts or more kicker checks or more goals set out, 1, 2, 3 years out in the future. So that's what's changed. And most owners, when you explain why that's the case, they get it because they've suffered in the last year or two. Numbers may be down, this changing economy. So they're going to pay a price whether they're an owner or whether they're a seller and now just going to work every day. So they're on the hook one way or the other. And when you explain it and why it's in place, they typically get it. Now, that being said, I never like to penalize a seller. If there's any sort of penalty for down numbers, I want the reciprocal that if an owner crushes it, we want an upside as well. And
Mhm.
typically we can get it. Buyers understand that. So there is a lot going on in the industry right now for sure. The numbers are off. Buyers are hyper aware of what's happening. They're trying to use it to their leverage. On the flip side of that, the companies that do come to market, they're garnering a lot of attention because there's not much on the market right now. And routinely, I get calls, from owners saying, "Hey, I get a call every week," or do you know this company? They've called me 9 times the last 3 months. I can't shake them, and it's not a bad thing to be wanted. But most of the time, these buyers know nothing about their acquisition targets. They're just looking for a possibly, or yeah, let's have a conversation. And now all of a sudden they're going to sit down and solve all the world's problems. So there's a lot to be desired between that first phone call and actually going down the road together. So I know we're probably off topic on that, but there is a lot of variables in your questions there, Michelle. So um, I'll circle back to consistency. If owners can be consistent, if they can have a plan, if they can be diligent in their decision making, the future is going to be bright. They just have to want to know and want to be intentional with their decisions, and that's why Violand is so valuable. It's Tim, I just got off the phone with one of your great clients, and you've really, really helped them out.
No,
And
thank you.
yeah, and I won't mention names here, but they were singing your praises, and it was a breath of fresh air for that conversation. They really were pleased.
Good.
I love it. Okay, so JT, kind of continuing with you a little bit, you just mentioned consistency. So is that something, does from the seller's perspective and buyer's perspective of these variables, does that shift? Like are the buyers looking for something different than what the sellers should be paying attention to?
That's a boy, another really good question. The the sellers, and I hope nobody takes this wrong, the sellers don't really know what a buyer is going to look at until they're made aware. Most sellers think that I've got a great business. This is what I've done for the last 20, 30 years. Why wouldn't somebody want this business? And when, Tim and I run through all these variables, I can say, Here's what's helping. Here's what's hurting. Here's how we add value. Here's a number to fix. When you fix it, we're going to add $500,000 to the price. It becomes real to them and it becomes very tangible. That's what sellers ultimately are looking for. They just don't know it yet until they go through the process. So buyers ultimately are looking for something that's bankable. They want to see numbers up. They want to see positive changes. They want to see a nice roadmap in front of them and projects booked and a stable team and all the things that that a seller wants. And Tim, you've said it multiple times: an exit-ready business is a good business, and so many are not. That once they get exit-ready, and Tim, I've sent several clients your way over the years that you get exit-ready, and now they're not ready to sell anymore. Yeah. Because now they're not pulling their hair out at night. They've become strategic. They can now sleep a little better, and they can do this for a few more years. And that's a perfect solution as well. So I think everybody's looking for consistency. The buyer just takes it to a new level and really peels back the onion 4 or 5 different ways and looks at more details than a seller does.
Tim, you have anything to add on this one? What buyers look for versus sellers?
That's pretty well said. I mean, and you're right, JT. I mean, what we're all talking about here is having a business that is predictable, and it's consistent with how it produces. If I had to take maybe a different look at it, Michelle, and come at it, if I were a buyer, if you want to ask the question that way, I would be looking for something that I can scale and I can optimize. Because chances are it's not my only purchase. I'm probably going to do more. So what the larger firms are looking for is optimization of individual departmental processes and procedures. How can I take a good business, use economies of scale either through the resources I've got already or opportunities that exist in the marketplace and turn a 5 times, 10 times growth, model on top of that without adding too much capital investment to it, pulling everybody's resources together. So I'd look for those things. I want a good fundamental business, but I don't want a perfect business that I can't improve either.
There's probably always room for improvement, I would think,
Oh,
but
sure.
yes. Okay. All right. So, JT, you touched on this a little bit. I keep putting my hand down because every once in a while Zoom wants to let you raise your hand and do bubbles. And so then I see this little thing at the bottom. Sorry, people who are watching don't care, but oh, don't make it look like I raised my hand. Anyway, okay. So what are some of the reasons that an owner might want to walk their company through the valuation process? And Tim, I'll toss this one to you first, but because I know that you don't have to necessarily be ready to sell, but there might be some good reasons to know what your company's worth.
Yeah, absolutely. I mean, there's a lot of them, and first succession and estate planning is a big one, right?
Yeah.
You have to really think about what it looks like down the road when you're ready to hang it up, and everybody does at some point. So, I think that's a big one. Any type of financing or capital raising events, if you're going to bring or borrow significant amounts of money, that lender is going to want to know, what is the enterprise value of the business? Insurability, you don't need if you're taking out large insurance policies, you don't need the degree of valuation that we have here, but you need to have an idea at least of what it's worth. And then certainly if you're going to go through any type of partnership, either formation or dissolution in your business, including divorce, then you're going to have some sort of formal and professional opinion on what the value of that business is. So that's kind of my hit list, if you will.
JT, what about you? Reasons to get an evaluation?
Yeah, great list. I mean, I've done valuations for loans and lines of credits, for partnership buyouts, life insurance policies, transferring to the next generation. And I say transferring because you don't always sell to the next generation. I value dozens of companies, 5, 10, 15, 20 million, and you might not turn around and charge your kid that or your children that, but they want to know what it's worth and then how to where that really comes into play is what if you're transferring a business to one child and another child that's not in the business? How do you keep that fair? So then I work with the seller and the estate planner on those kinds of issues. There can be employee buy-ins and buyouts, which is a real hot topic right now with phantom stock, unit appreciation rights and stock appreciation rights. Ultimately in my world, these are all valid reasons. But if you're within 3 to 5 years and you really want to know how to affect value, to get your business exit ready and you're willing, it's a great exercise to go through. I think I've done over 500 of these now in 25 years. And I have never, ever had a seller say that was just a complete waste of time. Most will say, love the number, but now you've given me a punch list on how to move forward with confidence the next 2, 3 years. And that is made up so easily. And the ROI that you put into it, it comes back to you tenfold in most instances.
So I'm guessing for an owner who's thinking about selling or maybe not, it's like, okay, I'm guessing valuation isn't a one-time event. Like, okay, we did this and now I know what it's worth and off we go riding into the sunset.
Mhm.
What does it look like? Is there a strategy for how far ahead of a sale you should get a valuation? How often you should maybe be getting reevaluated?
Well, you just said it. Sorry to jump in, Tim. I didn't know if that was for you or for me,
No, go
Go
but
ahead,
ahead.
JT.
one time you said it, a one-time conversation versus an ongoing conversation, and it should be ongoing.
Hmm.
Business changes, people change, the environment changes. It definitely should be ongoing. And profit centers will ebb and flow. And the more time you give yourself to affect change, the more you can. And you've heard me say this, and I'm sorry, but one more swipe at the dead horse here. You can say, or I hear regularly, oh, I really should have called you 2 or 3 years ago because now it's too late. And it's so easy sometimes to affect value. Quick example, let's say you're doing $1 million in an adjusted EBITDA and you're off a couple of percentage points. Okay. Well, there's $20,000. Okay. Simply. And let's say that business is going to sell for a multiple of 5 or 6. Well, there's 120 grand right there just based on 1 or 2 percentage points.
Hmm.
It's so easy to affect some decisions. And I think that's part of the magic of the analysis and ultimate valuation is owners don't realize that they're in direct control of that outcome 3 or 4 years from now, instead of being surprised and then not being able to do anything about it. Tim's job and my job is to make the road ahead smoother. Whether you're going to keep it for 10 years or sell in 12 months, let's make it smoother and avoid any surprises and put as much money in your pocket as we can.
Yeah, absolutely. Tim, what about you? Are these the kind of ongoing conversations that you have with your clients and kind of knowing if they have an exit strategy, making sure they know the valuation, making sure they kind of are going through this strategically?
Well, absolutely. I mean, that's why we exist at the end of the day. So if you looked at the term valuation as a verb, then yeah, it's an ongoing discussion. The value is a snapshot in time.
Yeah.
So if you just look at the number, the enterprise number that the business is worth, that'll change tomorrow, right? And even this afternoon, maybe. So it
Mm-hmm.
fluctuates up and down. The conversation that goes on, at least from a client consultant engagement standpoint, is where is it going? Well, is it moving up or is it moving down? Obviously, we want it to move up.
Yeah.
So optimizing or accelerating that growth curve is our main focus when we talk about value of the business.
Yeah, absolutely. Do either of you have stories or clients that come into your head where it's like, we prompted them to kind of go through the valuation process and then we were able to help them because I know JT, you do the same thing with people that come to you to get a valuation. You're able to help them walk them through how to get a better valuation maybe down the road if they decide to come back to it. I'm curious if either of you have kind of good success stories in this space, especially in the last few years when the industry has been a little bit harder, but there are companies that have managed to grow and do very well despite things being different now. So, Tim, go for it.
Well, I mean, we've got a lot of clients that are doing very, very well right
Yeah.
now. Maybe to the detriment of the competition, but the bottom line is they have paid attention to those conversations we have with them. They've followed the plan. They've been conscientious and aware of how the decisions they make day in, day out affect the ultimate value of their business. And at the end of the day, that's what you're looking for.
Yeah, absolutely. JT, what about you? Any kind of, I know there wasn't a specific story there, but I'm sure that that is true across Violand clients. And it's an interesting
It
conversation.
is. It is true. And there's dozens of success stories. As
Yeah.
mentioned, it's pretty easy to add value in incremental steps. And Tim, you just said it. They followed the plan. In fact, this morning I shot a restoration motivation video, my little 90-second clips, and it's titled You can't execute a plan you don't have."
Hmm.
And even a basic plan you can execute on. And if you don't have a plan, it's tough to cast that vision and tough to go get help when you don't really know which direction you're going.
Right.
So
Yep.
great choice of words there, Tim.
Hard to chase the vision if you don't have a plan.
There
Okay.
you
Good,
go.
good line. That's a snippet right there.
JT teed it up, so I didn't come up with it by myself. Um, okay, so wrapping it up, I would love for both of you to share kind of like one or two takeaways when it comes to valuing a restoration company, what you are hoping people walk away with. So Tim, I'll toss it to you first.
Well, the big one is clean financials. I mean, we have talked about that for two
Yes.
years now. Make sure your books are clean and that they're well kept, timely and accurate. Those are the two criteria. But the other one is just it comes back to education, and that's why we do these things. That's why I enjoy doing them, with you guys, is because we're all coming at it from the same angle. I mean, we're not looking for things to do in our day-to-day jobs, right? But educating our clients and educating those that are out there just makes the whole environment a better place. So if you've got questions or you're not sure what's involved in evaluation for a business, reach out to some credible advisors. We're always welcome to take phone calls, but lean on the experts in the field, and just remember, at the end of the day, the business is only worth what somebody's willing to pay for it, and an exit ready business is a valuable business. So that's what I'd leave you with.
I love it. Good wisdom. Okay, JT, your final thoughts?
I'll just come back to being willing. Sometimes owners are unwilling to have someone from the outside to take a look. And
Hmm.
when I ask why, what I hear the most is, "I was afraid what you were going to find," or, "I thought you were going to call my baby ugly." And with confidence, I can say that Tim and I will never call someone's baby ugly. Now, we may offer some help to say, "Here's how to make it cuter, more attractive. Here's how we dress it up." But I never call someone's baby ugly. I mean, they're out there in the field every day making it work, and
Hmm.
and you don't disrespect somebody's life's work that way. But there's always ways to make it better. And so, if you're willing and can put a little bit of time into making it better, the road ahead is always much smoother. And Tim and I, we help you avoid surprises. And if we can do that and put a little more money in your pocket, then it's a win for everybody.
Yes. Perfect. All right. Great wrap up. Thank you, gentlemen. Thank you to everyone who's here. You can find the rest of the Chasing the Vision episodes on CNR's YouTube, on the website. You can find on JT's socials, on Violand's socials. You can find them everywhere. So go back and kind of watch some of the past episodes if you've missed them. We have at least one more coming in this season with a special guest. I teased this up before. It's true this time. There's a special guest coming. So Tim and JT, thank you for all that you do for the industry. Thank you for your wisdom, and I look forward to seeing you on the next one.
Thank you, Michelle.